Hello and welcome to the Advance Your Wealth video series and podcast from Convergent Wealth. Today's video is going to focus on our Q2 of 2021 investment themes. And in this video, we're going to cover a wide range of topics and kind of continue on a lot of the things we've been speaking about in our client meetings recently, as well as looking backwards on some of the things that we think are the most important to be focused on from what we've learned in the last quarter and what that's going to lead to in the upcoming quarter. So agenda for the meeting today, first, we're going to go back and look at Q1 of 2021 and look at what happened in the markets, look what happened in the economy, and how did some of the themes that we thought would play out in Q1 actually work out. Then we're going to dive into what we think are going to be the most important themes for Q2. So what are going to be some of the areas that we think are going to perform well? And what are some of the economic drivers and market drivers behind that? And finally, we're going to dive into this continued theme of the death of the 60/40 portfolio and some of the underlying changes we're seeing in the economy and markets that we think are going to be important to be paying attention to over the long run. So first, before we dive into the quarterly themes, I always like to start and really focus as well on our investment philosophy as a firm. And it's really all about making sure, as always, that you're in alignment with your goals. And in this case, from an investment standpoint. So the why of your investment portfolio to us is just as important as how we invest the money. And so really, it's all about understanding the why and creating a very personalized approach to building a portfolio around your goals and your needs based on our assessment and your own assessment of your risk and your ability to take on risk and volatility in a portfolio. And that's going to help us answer a few questions. Number one is, do you have enough money to hit your goals? Is it in the right places? And ultimately, how do we best take that money out from an income standpoint and from a tax standpoint to optimize your overall financial situation? And then once we know those answers, that's really how we're going to best optimize the big picture for you. So with that, let's jump into a review of the markets and the economy from Q1. What we really saw in January was the markets really got on fire pretty quick. After a little bit of a dip in the first couple of days of the month, the market shot up and really were hitting all-time high on a pretty consistent basis throughout the month. But then we went into some really interesting volatility events late in January, and one that really hit the headlines was GameStop, the symbol GME. There were a lot of stories around Reddit and a bunch of these investors that were trying to short squeeze some of these hedge funds. And GameStop went from the kind of mid-teens in stock price from December all the way up to over $400 a share by the end of January. And there was a lot of volatility, a lot of news around this. And then it fell pretty sharply pretty quickly after that. And it wasn't just GameStop. It was stocks like AMC and a lot of other these stocks that had a lot of short interest in them. And while the news was really around how it was these individual investors that were kind of coming after these hedge funds, what we really know is that it wasn't just the individual investors that benefited the most. Oftentimes it was big investors that came in as well and really pushed those and really pushed the squeeze on those shorts. So what that did, though, is it took some of the steam out of the larger stock market, the S&P 500 itself, as a lot of focus came into these mostly small cap, high short interest names. But as we went into February, another headline really took control of the markets in the quarter, and that was really this steady rise we've seen throughout the first quarter in the 10-year Treasury yield. And if we look back to Q4 of 2020, the yield is still sitting closer to about 0.5%. And now we're sitting over 1.5%. So over the course of the last quarter, we've seen a rise of about 1% in the 10-year Treasury. But just in February alone, we saw a very steady and steep rise. And that really led to some additional volatility, especially in sectors of the economy and the markets that are particularly sensitive to moves in interest rates. And so really it hit the NASDAQ the most. And so while all of the stock indexes kind of took a breather during this rise of interest rates, the component that did the worst was the NASDAQ, which was down about 10% during this time frame when the 10-year yield went significantly up. But as things settled down and as things kind of clarified of where things were going, especially around stimulus coming into March, we saw the markets rebound pretty significantly into late March. And really, again, that's coming from a couple of things, but one of them really is this idea that this 1.9 trillion in stimulus is going to help support the market, because in addition to that, we already saw a significant buildup from the previous stimulus packages that already had a lot of cash on the sidelines. And so we assume, or a lot of people assume, that this additional cash is going to be very supportive to the markets going forward. So when we look back at the quarter, how did things do overall? And so while at times the S&P was near flat almost through much of the quarter, the last part of March really brought things home, and we ended up with almost a total of a 6% return in the S&P 500. We saw the NASDAQ do well at times and was really leading the way through mid-February, but as interest rates really took off, it became one of the laggards and is now up only about 1.56 at the end of March. And then what's interesting, and I think what a lot of people weren't expecting, even with the rise in interest rates, is that if you looked at the aggregate bond index, the AGG, it was down over 3% on the quarter. So if you're a conservative investor thinking you're safe in bonds, you actually very likely had a negative return in your overall performance of your bond fund. So let's take a look, though, at some of the themes that we thought would perform well in Q1. And one of the ones that we were pretty high on was growth. Tech was one of them as well, but really growth in general. And that really comes in the form of small cap stocks. And while they were up as much as about 20% at the peak, they still finished the quarter up about 13% on the small cap index. Commodities was also an area that we thought would do well. And again, it was doing well, especially through the end of February, up about 8% till then, but still finished the quarter up about 5%. And then emerging markets, while again, similar to technology, had a really good run early in the quarter, still finished the quarter up close to 4% on the quarter. So all of our themes did well. Not all of them outperformed the S&P 500, but when you combine all of them together, especially the small cap, overall, we felt we had a pretty good quarter in the models that we're managing for our clients. So another, in terms of economic review for Q1, things that are continuing to be areas that we're looking at going into Q2, was that we saw a steady increase of jobs being created. So about 1.4 million jobs were added in the first quarter of 2021. And we also are beginning to see GDP accelerating to the upside. And that's going to be a big theme. At the beginning of the quarter, we talked about how we were heading into what we call Quad 2, which is accelerating GDP or growth and accelerating inflation. And we're seeing a lot of those same things play out, and it definitely played out throughout Q1. Another one of the things that we're seeing as a strong tailwind, so we've been talking about a steady market performance, slightly increasing inflation is one of those areas that we're starting to see. But there's a lot of other tailwinds. We're in this period of time where there's going to be a lot of easy comparables, and we also have the stimulus package. But one of the big tailwinds that's going on right now is this vaccine rollout, and we're really seeing that accelerate as we get into quarter 2. So really, in summary, as we look back at Q1, as we were finishing up 2020, we really did see that there was going to be an opportunity for all these tailwinds to be supporting the market. So we did re-risk all of our models. And in particular, we went a little bit overweight onto small caps, commodities, and emerging markets. And what that led to was a really strong performance across the board in the markets and in these areas in quarter 1. And so, this is how we're really thinking about things going forward, is while we keep the base core of our models, spread and diversified across US large cap, small cap, mid cap, international, we do want to make sure we're focusing on some themes that we think will outperform. And so as we head into Q2, I want to really dive into some of the areas that we think are going to be really impactful for how the market and economy does in the months ahead. So this is just a quick review again of how we think about the markets in general and how we think about what might be impacting how the market's going to perform. And so we think about it in quads, and the two main factors are growth and inflation. And are they accelerating, or are they decelerating or slowing? And so right now, we believed as we were heading into Q1 that we were going to be in Quad 2, so accelerating growth, accelerating inflation, and that played out. We think that theme continues here into Q2. So we think we're going to see continued economic growth accelerating and continued inflation acceleration here into quarter 2 of 2021. And so in terms of the raw numbers where we see things headed, we believe we're actually going to see one of the largest quarter over quarter increases in GDP in history. And so as you see from the first chart here on GDP projections, we're expecting a number over 10% of year over year GDP growth. Now it's coming off of the heels of pretty terrible numbers, year over year numbers each quarter of last year. But we see this massive, you can kind of see the line going up from when we were down to negative 9.03 year over year in Q1 of 2020 to now over 10% year over year in Q2 of 2021. We've seen this big acceleration in GDP. What you'll notice though, and we'll talk about this more in a little bit, after this next quarter, that acceleration in GDP begins to slow. And so it is something that we're going to be needing to focus on, is what happens after Q2. The same story, though, happens with inflation. We've seen this significant acceleration in the rate of change of inflation. And our belief right now is that we're very likely to see some of the CPI numbers by the end of Q2 have a 3 in front of them, which we haven't seen in quite a long time. And we're projecting a little bit higher inflation than many of the others are. But same deal, even with that, when we get into the second half of this year, we do believe inflation is going to begin decelerating on the back half of the year. So what are the reasons for this strong performance though that we expect in Q2 of 2020? And really it comes down, and this is a theme we've been talking about a lot in our meetings with clients this quarter, is the year over year comparisons are going to be off the charts, and not just on GDP. It's going to be on almost every sector of the economy, whether it's services, manufacturing, aggregate hours worked, durable goods orders, all of them, retail sales, all of them are going to be off the charts year over year. And even though that is generally known, it's not going to be a surprise that that's the case. It's still confirming when you see all those numbers come out. And we believe in many of the cases, the year over year comparisons are even going to be better than expected. And so we think that's going to provide a lot of tailwinds, at least in the first part of quarter two. But again, we're not completely out of the woods, and we're not, of the belief that there aren't any concerns out there. One of the big ones is, while we have seen a steady rise in employment numbers and jobs created, there's still an $8.5 million gap in the number of people that were employed prior to the pandemic that are employed today. And so on the current pace, if we're adding 1.4 million jobs per quarter, and if that doesn't accelerate beyond that, I mean, we're looking at a significant amount of time, still well over a year and a half, before we get employment back to the level that it was prior to the pandemic. So still a lot of concern there. And then the other one is inflation. And so right now, while we're still sub 2% in some of the reports on inflation coming out, if we do start to see numbers above 3%, could that start to have an impact on growth and people's ability to, day-to-day expenses, be able to cover those day-to-day expenses? And what does that do when that starts happening? So again, while there's a lot of positives as inflation first starts to come in to the picture, it does get to a level where it does become a concern down the road. So in terms of how we're thinking about quarter two and some of the areas that we're going to be adding to our portfolios to take advantage of these themes, first is going to be inflation-focused equities and commodities. So historically, that's the types of investments that do well when we see growth and inflation accelerating. Also industrials and financials. And so in particular financials, as we see rising interest rates, that's good for financial stocks. And so we're going to be looking at adding some specific investments there. And then finally, some of the areas that have been beat up the most or haven't done as well as like the US stock market, and maybe even areas like China and other markets that recovered more quickly. The European stock market has been a laggard overall. And so we think there's going to be a chance for some outperformance there, as well as some of the emerging market economies that are focused on commodities. So these are going to be some of the most important themes that we're going to be focusing on. And we'll be making some adjustments to our portfolios to try to take advantage of some of these things. So to wrap up, the third main area that I want to talk about in the video today is, again, a theme that we've been talking about a lot in the last quarter. It's been a part of each of our quarterly and monthly investment videos over the last few months. And that's this idea of the death of the 60-40 portfolio. And the idea of that is that we've been in this 40-ish kind of years where we've been in a steady drop of inflation, as you can see on the chart here. We've had a steady drop in interest rates. And we've had a steady acceleration of growth over the long run. So we've been overall, even with, although there's been times of recessions and times of stock market volatility, we've been in a very steady economic growth cycle over that time frame. The problem is, and that's evidenced by looking at, if you looked at a chart of the performance of a 60-40 portfolio, so 60% equities, 40% bonds. Again, yes, there's been periods where that hasn't performed super well for short periods of time, but over the course of the last 40 plus years, you've seen a very steady rise, and from a risk-adjusted return basis, it's been a very steady portfolio. So usually, as the stock market was having trouble, you could have the safety of being in bonds, and even if the prices weren't going up, you were at least getting a steady coupon with a much higher interest rate than we have today. The problem is we're seeing stock market at all-time highs. And we're seeing interest rates, even though they've gone up 1% in the last quarter, still near all-time lows. And so in an environment, if we were to get some significant volatility in the future, the bonds aren't going to be as good of a hedge as they have been in the past. And if we see significant inflation, like we saw in the 1970s, with interest rates as low as they are and bond yields as low as they are, you're not going to get the types of return you need to keep up with inflation in that type of an environment. And another way I think that's really clear to see this is this chart that we got from our friends at Newfound Research. And it's looking back at what do you need in terms of a portfolio allocation and construction to achieve a 7.5% rate of return. And in 1995, and why this is important is that usually pensions, insurance companies, endowments, they use 7.5% as kind of the target return in order to meet all of their future obligations. And it's a pretty typical number that investors think about as well. And if we look back at 1995, you could achieve 100% of that return that you needed just from US Treasuries. And the risk on that, the level of standard deviation was pretty low. If you just fast forward to 10 years to 2005, you now needed to have a 50% equity, 50% bond portfolio to achieve that same expected 7.5% rate of return. And finally, if we look at 2015, that went all the way up to about a 90% equity portfolio, 10% bond portfolio to achieve that same 7.5% rate of return. So what we're seeing is that investors are being forced up the risk curve. And when you look at it from a standard deviation standpoint, from 1995 to 2015, you're taking on about 3 times as much risk to achieve the same 7.5% rate of return. So to us, that's a big problem. And also what you see in an environment like this is that all of these investments, even all those stock investments, the equity investments, even though it looks like it's diversified because you've got US large cap, US small cap, private equity mixed all in there, when we get to times like March of 2020 or 2008, 2009 global financial crisis, all of those asset classes end up going down together. When times are good, they all go up together, and that feels good. But the reality is, if you open up your portfolio and everything you have invested is going up at the same time, it probably means it's all going to go down at the same time. And so we are thinking as we head into, potentially a shift to where we're not going to just be in this steady growth environment like we've been in for the last 40 years, we're going to need to have other asset classes incorporated into our client portfolios. And so we've been talking about this again a lot over the last few months. And one of the examples that we use is if we think back to the Chicago Bulls of the mid 1990s. Up to that point, the team was already great. They'd already won 3 championships with Michael Jordan and Scottie Pippen. It was kind of like the 60-40 portfolio. If Michael Jordan was having an off night, Scottie Pippen was there to pick him up and vice versa. And so you had this really great team. But then what happens in the mid 1990s is they add this very colorful character to their team, Dennis Rodman. And Dennis Rodman is the lowest scoring inductee into the Basketball Hall of Fame. So offensively, it would look like a team of Dennis Rodmans would be awful. It wouldn't be a good team to have. But if you took one Dennis Rodman and you add him to a team like the Bulls, and really any team he was added to, when he was on the court, the offensive efficiency of that team went through the roof, even though he himself was not a good scorer. And the reason was he had one particular unique skill set, and that was offensive rebounding. And it was off the charts, his level of ability to offensive rebound. And if he was able to get 6 to 7 offensive rebounds a game, and he was throwing it back to the likes of Scottie Pippen and Michael Jordan, who are going to make probably around 50% of their shots, you're adding 6 to 8 points a game to a team that was already good. And most importantly, what if it's the fourth quarter when you're down by one, and that's when you get that most important rebound? And so at the most important time of the game, you're able to bring this opportunity for your team to get the winning basket. In the investment world, long volatility is the asset class that we kind of link with Dennis Rodman. It's this unique investment that when you need it the most, when everything else is going down, when the market's going down, when bonds aren't performing well, when everything is struggling and there's high volatility, this asset class typically performs extremely well just from the way that it's designed. And it works. Another way to think about it is like home insurance or portfolio insurance, but like home insurance. So your home insurance, you pay a premium every year for your home insurance, and you don't get anything for it until something catastrophic happens with your home. But if your home burnt down, that insurance policy ends up bringing significant liquidity back into your personal financial situation. The same thing happens with long volatility in your investment portfolio. The option strategies that they use, in particular, buying long out of the money put options, when the market's at its worst, when it's down its most, and when volatility is the highest, it brings significant liquidity back into your portfolio and protects some of that downside. So it's an asset class that as we anticipate that volatility is going to be higher, that inflation is going to be higher, that along with other asset classes like commodities are going to be needed to be considered. And when you look at portfolio construction over the long run, if you add two asset classes that are typically anti-correlated, meaning they're moving against each other often, but when you combine them together, what interestingly happens is that they can actually do better than two asset classes that are typically going up at the same time, and it reduces the volatility in your portfolio over time. So that's what we're trying to look at is, can we find asset classes that when we combine them together can reduce the overall volatility of a portfolio over time while still maintaining the return that you need in your overall portfolio to hit your goals. So in summary, when we look back at the presentation today, what we see is the big one is that we anticipate a continued theme of global quad 2 and Q2. So not just the US, but most of the rest of the globe and the world is going to be in this accelerating growth, accelerating inflation period. However, all those things that are tailwinds today in quarter two, a lot of them are going to be turning into headwinds for the market as we head into Q3. And so we're going to be looking at, when is it going to be the right time to be a bit more cautious about our approach into the markets. And then finally, just our continued theme around needing to be considering other asset classes in your portfolio as we head into potentially more volatile times ahead. And so with each of our clients, we're going to be building and constructing some solutions around this for you. We've been working hard on this over the last 6 months, and we're going to be excited to bring more information on this to you here in the near future. So with that, as always, if you have any questions on your individual situation, please feel free to reach out to us at Convergent Wealth Partners. We're happy to do a stress test on your individual portfolio and see how our themes and our strategies might apply to your individual situation. So with that, we hope you have a great quarter, and we'll look forward to talking to you soon.